Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about some very positive news on rates, finally. Logan, welcome back to the podcast.
Yes, I just got back from Tampa right now. It's Friday morning right here, and the chart daddy is ready to go to work.
No.
I'm glad that, we're incorporating a lot of new charts, and people are having a lot of fun with it on Instagram. So it's been a fun 48 hours.
Yes, they are making me laugh every time I see it. Okay, rates. That's what we want to talk about today because there's so much that happened this week that's going to affect rates. So let's start. Where do you want to start? Inflation?
Well, so let's take this week right now. As we're talking, it's Friday. It's a few hours after the PPI inflation report. We're kind of right here at that 420 level. So number one, we've talked about this level. This was going to be a tough nut to crack. That's 10-year yield.
Okay.
Yeah, 10-year yield at 420. So even with the better inflation data, the PPI data was a little bit hotter. But when you break the internals, we talk about that in the article we wrote this week, that what the producer price index has is that some of their components in there filter itself or goes into the PCE inflation. And some of those components like insurance, medical, those things weren't as bad. So the 10-year yield went up a little bit, came back down, back and forth, hasn't gone anywhere. So we're here. But the spreads, holy spreads, Batman. The spreads are getting better. I've been pounding the fist on this that, this is such a big story that we don't hear a lot about it because people say, well, the spreads aren't back to normal, but the spreads were really bad last year, right? So if I took today, boy, you could almost make a case, the worst case scenario, almost a 65 to 70 basis points higher in mortgage rates. I took the worst.
What do you mean? Yeah. Oh, if you took from the past?
If I took the worst spreads levels of last year and incorporated them today versus the spreads today, it's a 70 basis points difference. That's how important it is that the spreads start getting better. So rates are a little bit lower again today, but man, I'm telling you, if you can break under 420 on the 10-year yield, and the spreads get better, we're going to be at the kind of the setting new lows for 2024 in rates. So we want to talk about how much lower, like realistically, how much lower can rates go for the second half of this year? We'll cross 2025. We'll cross that bridge later. But going back to the forecast of 2024, I don't do mortgage rate targeting forecasts. I hate that. It's like you put a rate there. 3 months later, you come back and go, okay, we're updating it. Goodbye. See you guys in 3 months. No, we do this day in and day out because we want to track the economic data. And remember, paper, rock, scissors, right? Labor over inflation. The 10-year yield is still at 420, even with all the progress we have made with inflation. But the rate range was 7.25% to 5.75%. And it's not, the closer we get to the first Fed rate cut, the spread should get better. Spreads were acting a little bit better earlier than I thought they would. So in this case, 5.75 to 7.25 mortgage rates for this year, the range. Spreads, if they get better, you could get to that lower end faster. But the 10-year yield really needs to start breaking down. What has occurred is that the Federal Reserve is starting to lay the foundations of being concerned about the labor market, right? They've always used Sarah, how many times have we've just basically talked about the Feds? We're still restrictive because the labor market allows us. We follow jobless claims; it's going lower. So now we're starting to move to a different phase where the key data lines that the Federal Reserve has used are not, tight anymore for the labor market. So they can't use the excuse anymore. So if the economic data starts to get weaker now, if the labor market starts to get weaker, the bond market is starting to sniff that out. And this time, if the 10-year yield goes lower, there's more of a case that it can stay lower without spiking back up toward 4.5, 4.75 or 5%. And in that case, we can have a lower range going out in the future. But again, that really revolves around labor data getting weaker. right? If the labor data does not get weaker, it's going to be a slow slog. Even today, we're still at 420. The reason we're getting lower rates than some people anticipate is because the spreads are getting better. But just imagine if the spreads and the 10-year yield both go lower together.
Yeah, that's the dream right there. We even had Powell on, he was giving congressional testimony this week. So we had him talk 2 times. It didn't seem like the market reacted to that very much, more so the inflation. What do you think?
Yeah, I mean, the market was pretty calm because everybody was kind of waiting for the CPI report. And with the PPI inflation, we're not going to get it doesn't look like we're going to get a very cool PCE inflation print, but there's more progress already on PCE inflation. Now, just remember, I know there's all the PCE, CPI, all, OPP. Are you down with me? What I know, there's a lot of lingo out here, but the PCE, personal consumption expenditures, that is the Fed's main inflationary target area. When they talk about 2%, they're talking about that. They're not talking about CPI inflation. We give so much attention to CPI, but it's so tilted to shelter, right? So it's not the same case. 45% of CPI is shelter inflation, like 16, 17% is PCE. So the PCE inflation is showing us a slower year-over-year growth. So when we think about this right now, we have to look at kind of the PPI inflation going into PCE, and we'll see if that starts to trigger more positive responses. Because I'm telling you, we literally had lower mortgage rates with higher growth of inflation, right? So I know it's strange to think about this in that way, but we're in a different part of the cycle that needs a little bit more economic weakness or labor data weakness to really kick it in, or will, like we are right now today, still at 420. So we kind of, that 6%, sub 6% mortgage market. And the reason I always say sub 6% mortgage market works is because the builders have shown us that's really where you can grow sales, right? That they kind of target that, 4.25 to 5.75, area if they really need to sell products. So here we are right now, heading toward kind of the low 6, or we can get there. But if we get the Fed on board, and we never want to wish or hope for a job loss recession, but if we get there in terms of actually trying to be proactive for pushing, home sales to grow in this country, you got something that you can work with from these very low levels of sales, right? So 4 of the last 5 weeks, purchase application data has been positive. No one's talking about that. But imagine if rates keep on going lower for the rest of the year, and we still have to get that bounce that we usually see. It's a workable thing this year, where it wasn't the last 2 years, right? The last 2 years was kind of like, the Gandalf line, and the labor market wasn't breaking, job openings were still too high. So we couldn't get the conviction, but now we might actually get conviction here. And that means a lower level for a longer period of time without like the concern of, my hearing rates are going back up to 7.5 again, or something of that nature. That makes a huge difference, because if the spreads get better, Sarah, we are sub 6% today. If the spreads just get back to normal, we are sub 6% mortgage rates. That makes a difference, because the new home sales market has showed us that makes a difference with them. So here we are, the existing home sales market, 3rd calendar year of the lowest home sales ever recorded in history. It doesn't take much to bounce this market from these depressed levels.
It's crazy that you say sub 6% market. We could be there if we had better spreads, because it feels like we've been in the rate purgatory now for almost a whole year.
And just the history of spreads. Going back to the early 1970s, if you look at this data line, there's been a lot of periods where the spreads get worse, and then they eventually get better and they get back to somewhat normal. Okay, we have been in a bad area for a very long time, right? So it's going to shock people. I mean, just this morning I saw some people being shocked, right? It's the first time they're like, "Whoa, the rates are pricing better." And I said, yeah, the spreads are getting better. So this is why I keep on harping on the spread story, because if the Fed starts cutting rates, and the spreads get better, boy, you got a double whammy effect. And we have never had to talk about the double whammy positive effect here for housing in a while.
Well, I think we all would welcome that. And now, I mean, we've had inventory growing, and you've talked about how that gives us a cushion so that when rates do fall, it's not going to go straight into a savagely unhealthy housing market again, hopefully.
There was a reason why I wrote that article, the tracker article with the headline, "We're in a better position to handle lower rates." Of course, there's parts of the country that are not very high in inventory, still near all-time lows. That's not a good spot to be in when rates are lower. But in general, the nation is higher, right? So the farther we are away from 240,000 single-family homes, it's so funny, Sarah. Whenever I talk across the country, you've seen this. When I tell people how low inventory got in March of 20, there's this gasp, and then you talk about, wow, country of 336 million, over 159 million people working, hey, boy, too many people chasing too few homes. But now I feel much better. This is why I love 2024. And now we're starting to get crumbs, reasons, real reasons why rates can go lower, right? And it's not the growth rate of inflation. The growth rate of inflation has fallen a lot already. It's the labor market that the Fed cares about. The bond market now twice has tried to get ahead of the Fed, and it hasn't worked because the labor market wasn't breaking. We're not breaking here, but we're getting softer. So it gives a little bit more credence to the move. And then eventually, if the Fed wants to be a little bit more proactive, and especially for the housing market, I know Jerome Powell talked about, the best thing for the housing market that we can do is get inflation down to 2%. What I'd love to see is me being wrong on this one. I just don't want the Fed to pivot way too late, and then all of a sudden, jobs are being lost. And in a sense, I tell people all the time, every event, I said disproportionately housing will benefit here. And you're going to get crazy people that are going to say, "Oh my God, millions of people, or people are unemployed. Who's going to buy homes?" Listen, guys, we had 20 to 30 million people unemployed during COVID. We had 5 million in forbearance. We knocked off 35 million people off the grid, right? You couldn't buy homes. Literally, mortgage demand came back in 6 weeks. We were already pre-cycle highs in total sales for existing homes in 2020. So think about my army's bigger than yours. The chart daddy has a massive army. Right now, if I wanted to count the self-employed people and everybody, I got over 162 million people in my army. So whether you have a couple of 100,000 people losing their jobs early on and maybe 2 million, you want to take your 2 million against my 160 million? Oh, no. You better have a lot of dragons, rolling with your crew on that stuff. But no. So housing gets disproportionately hit in the benefit factor, and for that, but you don't want housing to benefit because of people are losing their jobs. That's a negative. So I'm hoping that the Fed lands the plane, like we've always said, and gets us to the other stage, because especially in the construction area, we are seeing some deterioration, and the deterioration that we're starting to see are traditional, what we see early on right before the recession happens. So we want to avert that. Like we kind of had the last 2 years. In November, rates go lower. All of a sudden, builders are happy again. They start issuing more permits, and then we can move it. Apartment sector a little bit different, but I feel so much. I feel so much better 2024 than 2023. Right? It's a healthier market on the inventory side. We're making progress on how we can get rates lower and staying there, and it's a good spot to be in. Because guess what? It's not housing 2008. No, it isn't. Oh my God, we are just absolutely lighting it up on fire with the charts that we're showing on how much equity people have or how low rates have, and it's just nothing on the credit side looks like 2005, 6, or 7, 8, and people like for me, I'm such a nerd. I just assume everyone knows this, and every time I show these charts out, especially on Instagram, there's people like, "What? How's that? Is that fake? Is it?" No, it's real. It's been here for years. So our job is to continually educate people, so people can understand. And when people can understand, they can show their friends, show Uncle Dave, right? Say, "Hey, Lisa, the chart daddy gave me this." right? And here you go. It doesn't look like 2008. No, it doesn't look like 2005, nor 7, nor 12 or 14. It's not even 2019. So hopefully, educating people and teaching people how to not, in a sense, read data and analyze, but just know what the chart is trying to tell you and making it clear and simple. So all of them become our army, right? They spread the knowledge, and that's a good thing.
So, you said that housing is disproportionately benefited. That's because housing was disproportionately hit. Starting in 2022, housing went into a recession because of the speed and velocity of those rate hikes by the Fed. I mean, it was just incredible. We all lived through it. So, I mean, it's understandable that we would now benefit because it's, the rest of the economy maybe has been doing well, but housing's been in a recession since 2022.
I talked to one of my housing crash friends about this recently, and I said, listen, the year that we created 4 million jobs, the housing market went into recession, the existing home sales market, because sales collapsed. So that was rates. Now, if I took rates down to 3%, will you be still saying home sales are going down 2.5 million? And just a slight pause. See, when you know how to read people, when somebody who talks too much, they have to actually pause for a second before trying to contemplate. They realize, oh, I shouldn't say that, right? Because lower rates, higher demand. We've shown this in late 2022 and late 2023. Just imagine if lower rates with duration, right, not going up higher, there you go. You get more sales, right? And again, the history of home prices going back to 1942, we don't see nominal home price crashes nor real nominal home price declines, really. Early 1990s, we had like a flat year and down 1%, but also 2008 was such an anomaly on a historical figure going back 7-8 decades. So it's funny because a lot of people tell me, well, its affordability is so bad. So then I show them the charts from 1974 to 1986. And they're like, is that home prices? Yeah. Oh, whoa. You mean you never knew this? They're like, oh, no, I didn't. I'm shocked. I am shocked. So the supply and demand equilibrium has to get weaker. Like I always tell people, if you look at 2022 data, when we authentically had home prices decline in the second half of 2022 with low inventory, low monthly supply, low active listings, that also came with the biggest and fastest crash ever recorded in history. Our new listings, active inventory, price cut percentage, the slope went super fast. Here, even in 2024, I mean, I had probably one of, if not the lowest price growth forecast for 2024. And it's been very stubborn to get there. And I was thinking as rates kind of went higher, if it stays here, then I could probably get to my national forecast level. But now rates are going down. That's the thing. That's what everyone needs to realize. You can't assume that rates are going to be elevated forever, right? At some point, they do come down. So if you don't adjust to it, this is why I always tell people, you don't listen to YouTube, TikTok, Instagram, stock trader trash, because they just naturally assume. They don't turn with the data. Whether positive or negative, they're always bearish, right? So when the forward-looking data starts to get better, like we try to talk about from after November 9th, you kind of go with that and then you read the data off of it. So don't assume rates are going to be 8, 9, 10%, like some people are saying. If they go lower and the forward-looking data gets better, you go with that, you read off the inventory. And this is the unfair advantage we have here at HousingWire, that Mike Simonson is the master of inventory data, and I incorporate the economic model variables into it. And the way we can look at the data lines to see ahead, and we look at everyone else who are already saying home prices were going to come down 5, 10, 15% this year, it's just, they're not real people, right? They're real people, but they're not real housing data analysts because they're always bearish in that sense. So we provide our model so everyone could understand it. And then when everyone understands, the society becomes educated. And Sarah, you know what I think about a society educated. When a society is educated, it is less vulnerable to being manipulated by fanatics and cult groups. And we always said that. There's a lot of men in this country do not realize as soon as they wake up every morning, they're still in that cult group. They don't get it, right? And there is no gold god waiting for you at the end. Trust me. It's not going to be there. Chart
Okay.
Daddy could give you the charts, but
Oh
it's
my
not going to be
gosh.
there. You're not getting a gold god, right? When you pass off to the afterlife. So, go with the data. Just let it flow, right?
Listen, now I'm already regretting the chart daddy reference.
Oh, people love it. Oh my
No,
God.
it's too
Woo.
much. Okay.
That was just as good as savagely unhealthy.
Okay, so I want to ask you a little bit about the 1970s data because this is something that we see a lot. People are like, when we talk about affordability, there's a whole picture there because you have sort of these generation wars where people are like, well, it's so easy for the boomers to buy houses. Yes, they had this really high interest rate, but housing prices themselves were so low. How does that look for wages? What is your take when you compare the affordability today with the affordability in the 70s?
So housing was booming in the late 1970s. That was when the baby boomers were millennials at that time. And even as mortgage rates were rising, home prices were up double digits year after year. So what occurred is that rates kept on going higher and higher in 18, 19%. And then home sales crashed, similar to what we see here. Back then, existing home sales went from 2 million up to 4 million, 4 million down to 2 million. So the way I like to explain it is that affordability right now, let's say, is just as bad as 1982 or 1983. Let's take one of those 2 years. But during the early 1980s, prices didn't decline. Not a lot of people know this. National prices didn't decline, even with affordability, in a sense, worse in the 1980s than we are right now. So again, one of the things about now, we have a lot of dual household incomes in America. So a lot of people keep on using the median income in a very incorrect way, because when they use the median income, they assume everyone is single or the family has that kind of income. I'm telling you, home buyers make more money than renters, right? So they say the family income is what, 70,000. No, it's not. Not the home buyers. This is why you have to take the aggregate total workforce and the dual household incomes, and then all of a sudden they go, well, you need 100,000 income to buy a house now. And the median income is, well, guess what? There's a lot of dual household incomes that make 150, 200, 250, right? So if somebody makes 90,000 and the spouse makes 70, there you go. That's how you get 5 million total home sales this year, near 5 million total this year and last year. So even with worse affordability in the early part of the 1980s, home prices did decline. Here, we're kind of at that level. So every time rates go down, it just makes it more affordable. The buyer pool picks up, just like it did in the 1980s. Now, in the 1980s, we're talking about 18, 17, 16, 15, 14, right? But because the rates were falling back then and affordable was bad, we started the increase after the crash in sales back then. We started to get that slow increase in sales, and rates kept on going lower and lower. You boost demand, you get the total workforce growing, you get more buyers, right, out there. And we had like 3 million active listings in the kind of early to mid part of the 1980s. We've got 1.128 million NAR data, which is going to go up a little bit. We are so far from the unaffordable times in the 1980s that didn't even have price declines back then. And again, if rates come back down and wages grow, remember, housing equilibrium is a moving variable because your wages grow every year, right? You lose jobs, you gain jobs, and then the rates come down. It makes it a little bit affordable. If prices come down and rates come down, so it makes it a lot more affordable. If prices go up, but rates come down, one variable's getting unaffordable, the other one's benefiting, but wages grow, right? And that's the thing that one of the reasons of being team higher rates was that, well, God, I don't want to see home prices go up 20% year over year. That's not a good thing. On a national level, that's a scary thing. The fact that the growth rate of pricing cooled, I mean, it's still, I might only get one of the 5 years of my years 2020 to 2024 might end up being, under the levels I wanted. I just wanted it's like, as long as home prices didn't go above 4.6% nominal, we were okay. That didn't happen. But cooling down prices was such a necessary factor because we need wages to grow into it. And then wherever rates go, they go lower, it becomes more affordable as wages grow. And that's the thing we have to think about. It's not set in stone here, right? People progress, they move on. And, in some cases, some people make more money than what they used to, but we push it forward, and we have to make sure to keep an eye on, prices not escalating out of control. We've seen what happens in Australia. We see what happens in Canada. We see what happens in the UK. We don't want to turn like those countries, right? And thankfully, we were able to get inventory to come up from those levels. That's like the number one thing for me. We did it. So I feel much better about rates getting towards 6% and demand picking up than, let's say, of March of 2022.
Okay, Logan, this is a happy episode. We're ending on such a happy note. It's been positive start to finish because there's so much potential here for rates to drop. We know that is going to boost demand. Looking forward to that. Thank you so much for being on.
Pleasure. And always remember, paper, rock, scissors, labor over inflation. Labor data really shows you why the 10-year yield is. But if the labor data starts to break, bond market is not going to wait for the Fed, right? If jobless claims, which actually fell this week, the jobless claims data fell. If jobless claims start to break toward that 323,000 level, okay, that's a legitimate recession concern, right? So we had people talking about job loss recessions with jobless claims tied to the civilian labor force at the lowest levels ever recorded in history. It's like, where do you guys get this? Oh, you listen to that guy on YouTube. So small steps every single week. Follow the tracker, follow economic data. If you don't want to follow economic, follow me. Chart Daddy's got it. And then we'll guide every single one day in and day out. Hold your hands and we'll go through it together. And then everyone gets to understand it. So everyone has a better scope, because you can't just talk about the housing market without talking about the economics of the US into the equation.
Appreciate it so much. We will talk to you again soon. Thanks, Logan.
Pleasure.